What if you could use the same investment capital to acquire more than one rental property? That is the idea behind this strategy. BRRRR stands for Buy, Rehab, Rent, Refinance, and Repeat. When it works, the investor improves a property, places a tenant, refinances based on the new value and rental income, and then uses the returned capital to purchase another property. But there is an important warning. The refinance is not an afterthought. It is the part of the strategy that determines whether your capital gets recycled or remains trapped in the property. I'm Marc Renz, and this is the Real Estate Capital Desk. Today we're breaking down how this strategy works, where the opportunity comes from, and what investors need to evaluate before buying the first property. This approach is a real estate investment strategy built around creating value and then refinancing that value. The 5 stages are buy, rehab, rent, refinance, repeat. Each step depends on the one before it. A poor purchase price makes the renovation harder to justify. A weak renovation can limit the appraisal. An unrealistic rent estimate can weaken the refinance. And a failed refinance can prevent the investor from moving on to the next property. That means this method should be viewed as one complete financing and investment strategy, not 5 unrelated steps. The first step is purchasing a property with enough potential value to justify the work and the risk. Investors often look for deferred maintenance, outdated interiors, poor management, below-market rents, and vacant properties. The goal is not simply to buy something inexpensive. The goal is to buy something at a price that leaves room for renovation costs, financing costs, carrying costs, and a realistic margin for error. This is where the expression, "you make your money when you buy," becomes important. The investor must know the likely refinance options before buying the property. The second step is renovating the property. The objective is usually not to create the most expensive house in the neighborhood. The objective is to make improvements that increase market value, improve rentability, reduce future maintenance, and support the expected appraisal. Typical renovations may include kitchens, bathrooms, flooring, paint, roofing, and mechanical systems. The renovation budget must be realistic. Investors should include labor, materials, permits, utilities, insurance, interest, taxes, and a contingency. A project that looks profitable before those expenses are included may look very different once the full cost is calculated. After the renovation is complete, the property is rented. This does 2 important things. First, it creates income. Second, it provides the documentation a lender may need for the refinance. The rent estimate should be based on actual market evidence, not simply the amount needed to make the spreadsheet work. Investors should review comparable rents, property condition, unit size, location, taxes, and operating expenses. A property can appraise well and still be a weak rental investment if the income does not support the debt and operating costs. The refinance is the heart of this entire strategy. The investor replaces the original acquisition or renovation financing with longer-term financing. The new loan may be based on the completed appraised value, the property's rental income, and the lender's seasoning rules. The investor hopes the refinance proceeds will repay the original loan and return most of the capital invested in the project. But this is where overly optimistic investment plans often fail. The refinance may produce less money than expected because the appraisal comes in low, costs were higher, or interest rates increased. The investor must know the likely refinance options before buying the property. Consider an investor who buys a property for $200,000. They spend $50,000 on renovation and another $20,000 on financing, closing, and carrying costs. Their total investment is now $270,000. After renovation, the property appraises for $350,000. If a lender allows a refinance at 75% of the appraised value, the maximum loan would be approximately $262,500. The investor would still have approximately $7,500 left in the property. That may still be a successful investment. The objective does not always have to be pulling out every dollar. If the refinance works and the property produces acceptable cash flow, the investor may use the returned capital to purchase another property. Over time, the investor may build a rental portfolio while reusing a portion of the same original capital. But repetition should not become carelessness. Every property needs to work on its own. This strategy has several major risks: paying too much, underestimating renovation, and overestimating value. Before purchasing a property for this strategy, ask, what is the realistic after-repair value? What is the complete renovation budget? And what happens if the appraisal comes in low? This method can be a powerful way to build a rental portfolio, but a successful execution begins with the refinance plan. And before we go, the Marc you've been watching is actually an AI avatar, but every script is reviewed by Marc and his team. I'm Marc Renz, and this is the Real Estate Capital Desk, presented by Horizon Funding Advisors. Thanks for watching. If this video helped you, please like and subscribe to the Real Estate Capital Desk. We provide practical guidance on real estate capital.
This content is for educational purposes only and does not constitute a commitment to lend, financial advice, legal advice, or tax advice. Financing programs, terms, and requirements vary by lender and transaction.